Currently, the yield curve is inverted, which has been a historical signal of recession and market declines. The 12 yield curve inversions since 1978 show the average time from inversion to recession is 18 months. This cycle, the yield curve has been inverted for 11 months as that inversion hit in July of 2022, which means history says we're about 6 months away from recession. So that begs the question, which stocks do well in a recession? Well, what does very well in a recession is being short the NASDAQ, being short the tech index. And you can do that through SQQQ. That's the ticker you can kind of go short on the NASDAQ. And I really do think that tech is a bit overweight in the S&P 500 and has been the outperformer. So since 2023 started, year to date, technology has outperformed all sectors and is up roughly 40% for the first half of this year. So, year to date, if tech is up 40%, that means it's the outperforming sector in the market. Well, I think we could get some mean reversion as once the market actually rolls over, that would cause rates to go up, which would hurt the technology sector more than any other sector. So yes, technology has outperformed to start the year, but at the end of the day, that outperformance is likely going to lead to underperformance if the market were to tip into recession. Also, currently the S&P 500 is seriously overweight the technology sector, which I think could lead to the market kind of right-sizing their position within tech. So how the S&P 500 works is, there are basically stocks that are bought by the S&P 500, and really the index is supposed to maintain a healthy, diversified balance. Currently, that diversified balance is not persistent through the S&P 500, as 27% of the S&P 500 is in tech stocks, and that is really unhealthy because the average weighting in tech stocks is only 16%. So that tells me that we're likely going to see some mean reversion once again, and we're going to see that technology weight come down. And for it to come down, the S&P 500 is going to rebalance and take out some of those names. And we actually saw that in the most recent quarterly rebalance. We saw a bunch of tech names get dropped, or not get dropped, but really have their shares, their weightings be dropped within the S&P 500. And currently, when you look at Nvidia, Apple, and even Amazon, those stocks make up a bulk of the index. I think that will change. I think the S&P 500 will once again be more diversified, and to really do so, they have to drop their technology weighting, which would obviously hurt pretty much every single tech stock and the broad, tech sector. So I think between both of those two kind of headwinds for the tech sector, I think it's very, very likely that the tech sector underperforms. Therefore, buying the SQQQ, which is just basically short the tech sector, you could really be benefiting from that underperformance of the tech sector once we tip into recession here. So SQQQ is the ticker I like. And then the second stock that I really do like in a recession is Walmart. And the reason really being, it's no surprise that a discount retailer like Walmart has outperformed during each of the past two recessions. Americans can't go without buying groceries when times are tough, right? But they can save money by bargain hunting at Walmart. So Walmart has plenty of growth levers to pull heading into 2024 to continue its recent positive operating momentum and expand margins. Walmart's first-party e-commerce business has reached a profitability inflection point, and higher margin businesses such as a third-party marketplace and advertising are growing Walmart's core brick-and-mortar retail business. And there's a bunch of buy ratings out there on the stock from Wall Street as well. Wall Street is very bullish on the stock, but if we just take a look at net sales worldwide, we can see that Walmart has been increasing these net sales drastically, and we've seen over 100% gain in net sales since 2006, and this has really just ballooned to $605 billion worth of net sales in 2023. So I think this likely continues, and we see Walmart gain more and more share. It's a huge store throughout the entire world, especially America. And when we take a look at the number of stores, they have 4,700 brick and mortar stores in the U.S. And that's definitely grown a good amount from about 3,800 in 2012. Therefore, I do think this number likely remains high, around 4,700 for stores worldwide, and just given their footprint across America and the fact that they're kind of the discount shopping venue, that really makes them pretty recession resilient. As when times are tough, customers, they're going to go to Walmart. They're still going to spend. Also, their online business, right, has grown drastically as well. Their e-commerce business has grown, and I do think that's going to help the company exacerbate the gains they have seen in their margins and profitability. So I really do like Walmart here. And just to kind of give you just a quick snapshot of their financials, so they currently trade at a 24 times PE, which is basically right in line with the S&P 500 and is right in line with Walmart's 5-year average of 23 times. So the company looks somewhat expensive relative to the sector, but when you consider the safety that this company offers, I do think it makes sense to kind of pay up. And like I said, they're basically right in line with the S&P 500, which trades at about 25 times PE. They also have a stable 1.4% dividend yield. And the balance sheet is very strong as well, as the company has a healthy amount of cash, $13.8 billion of cash on hand for the company, or about $5 per share in cash, which obviously definitely allows the company to kind of weather any upcoming storm economically. So I think that is great for Walmart. And then the third stock I really do like in a recession is Abbott Labs. So Abbott Laboratory is a diversified healthcare products company. It's understandable why so many healthcare stocks performed well during the pandemic in 2020, but Abbott shares actually outperformed by an even wider margin in 2008. And Abbott's diversified business model, strong balance sheet, and rising dividend will help the stock outperform its peers in the long term. And the slumping COVID-19 related sales will drag Abbott's revenue down 9% in 2023, but investors should anticipate a return to 5% plus growth in 2024. And there are a bunch of Wall Street firms out there with buy ratings on the stock. So yes, COVID, those COVID sales dropping definitely hurt the company. But at the end of the day, there is a massive drop in life expectancy in the U.S., and this company is really trying to kind of combat that. And the leading causes of death right now are heart disease, cancer, followed by strokes, injuries, diabetes. And just to kind of give you a breakdown of the business, so it operates in 4 main segments: the diagnostic products, medical devices, nutritional products, kind of fighting that diabetes deaths, which I was talking about, and established pharmaceutical products. It is worth also noting that BlackRock's favorite sector right now is healthcare, and it's for this exact reason, right? So BlackRock is pretty cautious on the markets at this point in time, and really a great way to be exposed to the markets without taking much risk is being exposed to healthcare, right? People are still going to take care of themselves regardless if they have a little less money in their pockets, right? They're still going to go and get their pharmaceutical products. They're still going to get their nutritional products. They're still going to take their supplements. They're still going to take their medicine, right? Their pills that they're prescribed to take. And Abbott Labs really is at the forefront of all of that. And then when we take a look at some of the financials here for the company, so the company has a 24 times PE, right in line with that market multiple, right? The S&P 500 is about 25 times. And when we compare that to Abbott's 5-year history of PE, we're actually at a discount relative to Abbott's 5-year history of about 26 times PE. So trading at a discount relative to its own history and right in line with the S&P 500, but we have that perceived safety in this stock like really not many other stocks in the market. We also have a 1.9 times, excuse me, a 1.9% dividend yield, which is another solid reason to be in this company. And then we could also take a look at the balance sheet. So the balance sheet, we have $8 billion in cash, or about $4.50 in cash per share. So all that really makes the company, have the ability to weather any economic storm that comes in its way. So Abbott Labs is really a great healthcare stock to own, and we've actually seen COVID cases tick up over the past couple months here, and Abbott Labs could be a major beneficiary of that as well. So with that being said, 3 stocks that I really like: the SQQQ, Walmart, and Abbott Labs, all 3 stocks that should perform very well in a recession, in a down market. So I hope you enjoyed the video. I will end it there. If you got some value from this video, please leave a like. We post company breakdowns and important market moving news on this channel on a daily basis, so make sure you are subscribed. If you would like to receive my daily portfolio moves, my exits, my entries, and see how me and my team of analysts are trading the markets, join the Discord through the link in the description below to get our free 7-day trial. Also, if you would like to join our free daily newsletter, sign up to our Substack, which is linked below as well. With that being said, good luck everyone. Happy trading, happy investing.